Hello, and thank you all for joining me today. My name's Jonathan Curtis, and I'm Head of Investments here at Skybound Wealth. Given the current situation in Ukraine and the headlines, no doubt you've all been reading about how the conflict is unfolding, we know a lot of clients and investors understandably have concerns and questions about the potential impact this could all have. So today I'll be discussing with you how events in Ukraine could affect your investments and markets. So let's start by looking at what's actually happened in the markets since Russia's invasion of Ukraine. Now, whenever there's a serious event, and this certainly has the potential to become a very serious event, there is also the potential for short-term market volatility, and that's been the case. When I say markets, I mainly refer to stock markets, as they tend to be the main drivers of returns in most people's portfolios, and certainly within our portfolios too. Now, global stock markets fell a few percent immediately after Putin's invasion announcement. Then they recovered within a day or two, but have since fallen a little again, and are currently around 3 to 4% below where they were immediately before the announcement. The global bond market also fell slightly, but as bonds tend to be more resilient than equities during market volatility, they fell less and again recovered within a day or two, but also fell back a little and again now sit just below where they were on the 24th. So have broadly gone sideways. Gold, on the other hand, immediately rose following the announcement, then fell back, but again has risen strongly and is currently around 7% up. So certainly there has been a bout of short-term volatility, including falls for equities and bonds. But actually markets were already falling before the invasion. And although we can never be 100% certain of the reason for any market movements, whether that's up or down, given markets can be impacted by many things, most investors might actually agree that the falls since the end of last year have actually had more to do with expectations for rising interest rates, given rising interest rates are generally bad for markets, rather than what's happening right now in Ukraine. So that's an overview of what's happened so far. And it has really only been a very short period of time. But I suppose the question many of you watching will want to know is, what else can we expect in store as a result of the conflict? Now, unfortunately, that's a really difficult question to answer, as, let's face it, we just don't know how the conflict will play out. It's still potentially early days, and probably, if we're honest, most people never would have expected Russia to have invaded in the first place, but here we are. How this plays out, though, is really anyone's guess. There are so many unknowns. More importantly, from an investment perspective, though, is what impact it could have on the markets. And again, we just don't know at this stage. Even if we could see into the future and know the outcome of this conflict, market reactions can be equally incredibly difficult to predict, at least with any consistency. Yes, there certainly is the potential for there to be more market volatility in store, particularly if the situation does deteriorate further. But at the moment, I don't think we can draw anything like a firm conclusion on how the conflict is going to play out, how it will affect markets, even over the very short term, let alone over the medium to longer term. And on that point, investors really should be focusing more on the long rather than short term. It's human nature to focus on the here and now rather than what could happen several years from now. And certainly when you see headlines about what's going on in Ukraine, it can cause obviously a lot of worry and anxiety. But really over the long term, events like this don't actually tend to have that much of a lasting impact on markets. So we think that's a really important point to bear in mind. But what about the economic impact, you might be wondering? Well, we've seen oil and gas prices were already going up even before these events in Ukraine, and they certainly have the potential to keep rising, given Russia is the second largest oil exporter in the world and the largest natural gas exporter. And together, Russia and Ukraine account for around a quarter to a third of the world's wheat production and about a fifth of the global supply of corn. So as well as energy prices potentially continuing to rise, we could also see food costs creeping up further too. At the end of the day, though, markets are not driven by the cost of petrol or the price of a loaf of bread. They're driven by the success of companies that make up the markets, and those companies are likely to continue producing and selling their goods and services all over the world in spite of what's going on in Ukraine and in spite of what potentially could happen in Ukraine. To put things into perspective even more, Russia's not even one of the world's top 10 economies. And Russia's even less significant from a stock market perspective. So Russia only accounts for 1/3 of 1% of the global stock market. So it really doesn't make that much of a difference at all from an investment point of view. So in short, yes, potentially more volatility from the market over the short term, but as economies and markets are not the same thing, and the fact that neither Russia nor Ukraine make up much of either the global economy or the global stock market, I would say that unless things really deteriorate, it's unlikely this will have a long-lasting impact on investors' returns. Now, for those that perhaps still aren't convinced though, let's look back into recent history to see what's happened following other significant events, and there are plenty of them. Obviously, very recently, even though it's not a war, of course, we had, and in much of the world is still going through, the COVID crisis. And I would argue that the fallout from lockdowns and restrictions we saw across the world, where entire countries and entire industries and companies were almost completely shut down, will have much more of an impact than the current crisis in Ukraine. So even though many countries are imposing sanctions on Russia, as we know, the main impact of this event is still contained to Eastern Europe, whereas COVID was, of course, a global event and really affected everyone, every country and every economy. And looking what actually happened as the initial strain of the COVID virus really started to rapidly circulate across the world. Towards the end of February 2020, markets plunged over 30% in the space of a few weeks. Now that really is volatility. Yet despite those really heavy falls, however, markets actually recovered within around 6 months and have risen significantly since then. We can also look to another kind of war, and that was ex-US President Trump's trade war with China. Now, to put that into perspective, there you had the two largest economies in the world, and that's largest by a very long stretch going head to head. And that really did have the potential to impact the global economy, and to a large extent, it did. Now, during the peak of that period's conflict in 2018, markets did fall, but again, after roughly 6 months, they'd recovered to where they were before. And again, since that point, they continued to rise. Look, there are always going to be events to give investors cause for concern. From a UK perspective, there was Brexit not so long ago. Back in 2014, Russia took over Crimea. So this isn't actually the first time in recent history that Russia's invaded Ukraine. Before that, we had the Eurozone debt crisis with Greece at the center of that saga. And many predicted at the time that could potentially spell the end of the entire European Union. In 2007, 2008, there was, of course, the great financial crisis. And again, many predicted that the global financial system was about to completely collapse and financial Armageddon was about to ensue. And there, of course, been plenty of actual conflict wars. The Iraq War, the war in Afghanistan, the Kosovo War, the Gulf War, and so on. And so the point I'm really trying to make is there always has been, and unfortunately, likely always will be, something to worry about for investors. But what history has shown us, though, is when we take the time to look back is that markets are resilient and they've always recovered from significant events, no matter how serious those events appeared at the time. And we really see no reason for that to change or be any different this time around. Now, as I mentioned, when I say markets, I'm mainly referring to stock markets or equities. While equities tend to be the main portion in a lot of investors' portfolios, and certainly in most of our portfolios, as we believe they have the most long-term growth potential, they also tend to be among the most volatile investments and can suffer more than most when things like this happen, whether that's the current crisis in Ukraine or COVID, or perhaps after the 9/11 attacks, and so on. So with equities, you'll likely see the biggest drops, which is what we've seen recently, also the longest times to recover, but also the steepest rises too. Now, for more adventurous investors who have the tolerance to see through any market turbulence, they'll typically have more exposure to equities in their portfolios, as that increases their long-term performance potential. But for the more cautious investors, they'll tend to have obviously less exposure to equities because they're not so keen on the bigger up and down swings of the market. And so they'll have more exposure to less volatile investments, such as bonds, and other types of investments that aren't necessarily less volatile, but tend to zig when equities zag, such as gold, for example, which, as we've seen, tends to work well during times of crisis and extreme market volatility, as investors flock to them in times of turbulence for their perceived safe haven status. Now, that's not to say lower risk assets won't ever fall. They certainly can fall, but we'd expect them to fall by less than, say, equities when they do. So why am I mentioning this? Well, that's because at this point, you may be wondering, should we be making changes to our investment portfolios? Maybe that's lowering more volatile equities and increasing exposure to less volatile asset classes such as bonds. And I certainly know many of our clients have been asking similar questions to our advisors in light of what's going on in Ukraine. My recommendation, however, would be actually that you do very little. Even though these events can and obviously have generated a lot of headlines, a lot of emotions, which can, of course, as we've discussed, lead to some short-term market volatility, investors' returns are going to be impacted more significantly, not by things that are happening right now, but by things happening between now and the next 5, 10, 15, 20 years or more into the future. So we think it's really important not to make knee-jerk reactions, but to stay focused on the long term and stick to whatever investment plan you've got in place. As I mentioned previously, if you were to make any changes in response to what is really an unpredictable event such as this, you could get your forecast of the outcome wrong, or you could even get that right, but get the market reaction wrong, or get your timing wrong. So there's all kinds of factors that you have to take into account and that you need to get right for any changes that you do make to your investments to actually have any benefit. Just get one of those things wrong and you could potentially end up with worse returns than simply doing nothing at all. And that's actually often what happens with investors who perhaps don't have the discipline to stay calm and stay focused on the long term. And that's why our focus has always been and always will be entirely on the long term. We don't believe our insight into the future is any better than anyone else's, nor do we think really anyone is actually particularly any good at making consistently correct forecasts about what's going to happen in the economy or in markets in the future. And so we really believe that the best thing that you can do, and this is supported by decades and decades of history, is to back the long-term success of the markets rather than trying to jump in and out or try to predict what's going to happen next. So given our focus on the long term, we're not going to make any changes to any short-term event, particularly one as potentially unpredictable as the one going on in Ukraine right now. Now, some of you listening may be surprised that we're not going to be making any changes. But if you are making changes in response to events after they've started or have already happened, you could effectively end up like a dog chasing its tail. You'll always be one step behind where you need to be for it to actually work. So instead, our portfolios have been built with what's called an all-weather approach. And they're called that because they're built for whatever scenario is in store, whether that's geopolitical crises, economic boom and busts, interest rates or inflation going up or down or sideways, and so on. And the all-weather approach involves investing in a broad range of investments that perform differently in different environments or weathers. So although, of course, when we built the portfolios, we never could have predicted Russia would invade Ukraine, we have included things in our portfolios like bonds and in some portfolios like gold that can provide some protection or even benefit when markets are rocked by crisis events. Now, all weather doesn't mean the portfolios won't suffer from falls, but they should provide investors with some protection in tougher times. And obviously the more cautious portfolios should offer more support, whereas the more adventurous ones will offer less support, but will have a higher long-term return potential. So it really depends where you as an individual are on that risk-return scale. Now, just to explain, in case anyone's wondering if there's any exposure to Russian companies within our portfolios, from an investment perspective, Russia is classed as an emerging market. And we do invest in emerging markets alongside developed markets within our portfolios. But the way we invest in emerging markets is through a fund that takes an ESG or environmental, social, and governance approach. And what this does is to screen out, or in other words, remove companies from controversial industries like oil and gas and mining. And those companies actually make up the vast majority of the Russian stock market. The fund also screens out or removes companies that are controversial in their own right. So what that means is within our emerging markets fund, Russian companies only make up around a quarter of 1%. And so in the context of our portfolios, that means our exposure to Russian companies is somewhere between 0 and less than 0.03% of the portfolio. So in reality, they have virtually no exposure to Russian companies whatsoever. Now, despite everything I've said, we appreciate some of you watching may still be nervous about current events and the state of the market, and that might be putting you off wanting to invest in the first place, or perhaps wanting to invest more at this current time. And that's a completely natural response. So you certainly won't be alone in feeling that way. But the reality is there is never a perfect time to invest. And the reason I say that is because to know when is the perfect time to invest, you'd need to know what the future holds in store. And let's face it, none of us do, and none of us ever will. Now, let's imagine, for example, you got your timing as bad as could possibly be, and you invested right at the start of the 2007-2008 market crash, when stock markets fell over 40%. Even if you'd invested on the day that the falls began, simply by doing nothing, staying invested, and focusing on the long term, you'd now be sitting on a gain of over 250%, or in other words, 3.5 times your money. And remember, that's getting your timing as bad as you possibly could have done. So the point I'm trying to make is it's very difficult to know when to enter the market because we simply don't know what's around the corner. However, markets go up more often than they go down. So you've also got to consider the impact not being invested could have in terms of missed opportunity. Now, no one knows where the top and where the bottom of markets are. There's no bell that rings to sound the top or bottom. And just as markets can fall suddenly, they can also rise very rapidly too. So missing out on those sudden gains could potentially actually have more of a negative impact on your long-term returns than sitting out on the sidelines and waiting for any volatility to pass. Having said all that, one approach for the more nervous investors among you could be to drip feed your investment over time. So rather than invest in one go, you spread your investments out, whether that's over 3, 6, 9 months, or even a year. And then you get what's known as dollar or pound or euro cost averaging, obviously depending on your currency. So if you've invested the first tranche, but then markets go down, your future tranches will be invested at a lower price. And if markets go up, your initial investment is benefiting from that. And your entry into the markets overall will be an average of those up and down movements. So to wrap up, our recommendation for those already invested is really just to sit tight, let these events pass, however long that may take, and remain invested. And that's because investing really is about focusing on the long term. No one knows for sure what's going to happen in Ukraine or any other event that's in store for us in the future. And as I said, there always have been, and unfortunately certainly always will be, things to worry about for investors. But those investors that end up being rewarded the most are usually those that can sit tight, can focus on the long term, and can stick to your investment plan and let the markets do what they do. And they do wobble around a lot, but over the long term, they've always gone up. And as I said previously, we see no reason why that will be any different in the future. So thanks again to you all for watching. I hope you found that useful, and I hope you have a better understanding of how we're approaching current events and how we'll approach similar events in the future. As I mentioned earlier, while we don't think the Ukraine crisis, as things stand, will have much of a lasting impact on your investment portfolios, it could very well have an impact on how much it costs to fill up your car or do your weekly shopping. In other words, we could see it pushing inflation up even more than it has already been rising in recent months. So in my next webinar, I'll be discussing what you can do to protect your wealth from inflation. So I hope you'll join me for that next session. But for now, thank you again for watching, and goodbye.